Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. I'm back in beautiful Vail, Colorado. I, first of all, would apologize for the quality of the video last week. It was taken from a hotel room at a resort in a place called Semiahmoo Bay in far northwestern Washington State. We spent the week traveling down the coast, Cannon Beach, Oregon, Bandon Dunes, Oregon, and on to Napa Valley, and made it back to Colorado yesterday. So our note this week was titled An Update from the Road. It was a somewhat abbreviated note. We were busy traveling around a bit, but there's some interesting stuff in there, we think. 3 sections to the report this week. The first one was a payroll review and the potential policy implications of pardon me, what was a very strong employment report. We then had a brief summary of the Infrastructure Act, which is working its way through the Senate as we speak, and as we would describe as a high likelihood of passage, which will then, of course, be followed up by the Human Infrastructure Act. And then a section reviewing the price action in the Treasury market. So to begin with, we titled the section reviewing the employment report is pretty darn substantial. There was some very impressive elements to this report. And quite frankly, we couldn't find any weakness in the report. But just to go through some of the numbers, the headline increased by 943,000 jobs. There was 119,000 positive revision to the prior 2 months. Full-time employment increased by 1.265 million. Part-time employment actually fell by 250,000. The competing household survey was up by better than 1 million jobs, 1,043,000. The unemployment rate, which is derived from that household survey, fell to 5.4% from 5.9. We actually think that that will go substantially lower over time based upon the survey results we see from the conference board's jobs plentiful, less jobs hard to get survey, or so-called labor differential. And then the U6 underemployment rate fell to 9.2% from 9.8%. So again, these were pretty impressive headline numbers. This is a Fed that is very focused on inclusiveness. So when you think about some of those elements to this report, female employment went up by 649,000. The unemployment rate for females, adult females, dropped from 5.5% down to 5%. The employment to population ratio, which is the broadest measure of participation, rose from 58% of the population to 58.4. Just think about what 0.4% of a 330 million population means. I didn't do the math, but you can. And then the prime age labor force participation rate for both men and women has increased fairly sharply over the last 2 months. So again, that's good news. People are going back to work. On the wage front, and with the implications for the Fed's inflation process, at the last press conference, Fed Chairman Powell talked about supply chain shocks, increasing the level of prices as a one-time level shift, but then talked about the inflation process and inflation getting embedded into expectations by a stronger wage growth. Well, there was plenty of evidence of that in this month's report as well. The headline average hourly earnings series, which we don't like very much, it hasn't been around very long, was stronger than expected, up 0.4. It was expected to be up 3. And the prior month, which was originally reported at +3, was revised up to +4. But our little model that we've created to look at the globalization effect, which is wholesale trade as a leading indicator for the manufacturing sector, then manufacturing wages, and then the second order effects of service sector wages and the aggregate private sector for non-supervisory average hourly earnings. That series has been around since the 60s. Those numbers are very impressive. They've moved up considerably. So to give you some broad perspective on that, wholesale wages are now increasing at 6%. That was 4.6% before the pandemic began. And remember, that process had started in early 2018 after the passage of the Tax Cuts and Jobs Act. Manufacturing wages are increasing at a 5.1% annualized rate for non-supervisory workers. That was 3.6% before the pandemic began. Service sector wages are getting dragged higher. They're 4.4%, up 4.4% versus 3.6% before the pandemic began. And then the total private sector is 3.7%, up from 3%. As a note, the way we calculated those was to look over a 2-year period and then take an annualized rate to smooth out some of the pandemic chaos. But those are your wage growth rates, and you can see this chart in the email going out with the podcast and with the video. We will have that added to it by our friends at Nucleus 195. The policy reaction to all this. Oh, a couple of more points on the labor market. Excuse me. One is labor market fluidity, dynamism, or turnover really look to be picking up this month as well. We saw long-term unemployment fall sharply, short-term unemployment go up. That's a sign that the labor market is churning, and the median duration of people being unemployed dropped very sharply by about 4 weeks. So again, dynamism as some of these extended and expanded unemployment benefits run off. And then finally, the outlook for next month is the early look would be favorable as well, given the expiration of these unemployment benefits, but the decline we're seeing in total continuing claims across all three programs, the regular state program, pandemic program, and emergency program, which extends the state program. So we would expect a very strong report again in August, and that'll set the stage for September tapering of asset purchases. We think is very much in the cards. The Fed speak last week. Fed Vice Chair Clarida described the inflation shock as much more than a modest overshoot. Fed Governor Waller in a CNBC interview was very explicit about what he would require to taper in September. Said we need a couple of payroll reports averaging between 800,000 and 1 million new jobs. Well, we met that hurdle for July, and it seems likely we'll meet it again for August. So we do think that at this point, a September taper is very much on the table, and the equity market in particular is not priced for it, nor is the belly of the Treasury curve. There's a political element to all this as well. Many of you have seen that Joe Manchin letter that he wrote to Fed Chair Powell. The GOP platform at this point for the 2022 midterms is going to be all about inflation and Democrats overdoing it on the stimulus front. That is a powerful narrative, and it does seem to be gaining some traction in some of the surveys. CNBC did a survey, for example, and inflation is a problem with the public now. So that is an issue that could force the Fed and get support from the administration to start tapering those asset purchases sooner rather than later. Again, as we've written about extensively, this will lead to a fairly significant equity market correction. So 2 more sections to the note. I'll keep my comments on those a little briefer. As far as the infrastructure deal goes, we titled that section, "It Could Be Worse," and it's going to be both the Penn-Wharton budget model and the CBO determined that there wasn't a heck of a lot of a productivity response to the planned spending, and there was going to be an impact on the deficit, a pretty considerable one. Most of the pay-fors are not really pay-fors. And this will, of course, pave the way for the human infrastructure plan, which will likely expand the deficit by $1 to $1.5 trillion under CBO and JCT scoring, but ultimately it will expand the deficit by more than that. And we do think the real implication for investors is the back end is going to wake up to this and start to move higher to discount the greater supply that's going to be a consequence of it. It would be great if federal government spending spurred additional private sector infrastructure investment and some at the state and local level. As we've commented on many times, the federal government is not where infrastructure is done. It's done at the state and local level, and it's done by the private sector. The numbers Federal government is about 4% of total public sector infrastructure investment. It's just not that big a deal. This isn't that much money, but it is additional spending to be sure. And the human infrastructure expansion of the social safety net around healthcare will definitely have negative budgetary implications. So moving on finally to the Treasury market, we would note that the Treasury general account balance is now down to the target of $450 billion. So that liquidity flush into the market has seen its denouement, if you will, and liquidity is going to be a little scarcer to come by and could actually start to reverse as we go through the course of the fall and start putting upward pressure on the market as opposed to creating a saturation that pressured the market lower. We would note from a technical analysis perspective, we had two impulsive moves in the 10-year Treasury down to 1.126. In both cases, you had quick reversals. Were that 10-year Treasury to break above 131, that would confirm a double bottom chart formation, and the measured move or objective would be up to 1.5%. Our fundamental view is pretty bearish on Treasuries, and we do think there's going to be a considerable rates rally this fall. But sometimes when technical analysis lines up with fundamental analysis, it gets us particularly excited, and we'll commit some additional capital to it. That's how we're thinking about this as well. So a couple of other side notes. As earnings season has progressed, profit margins for the S&P 500 have now exceeded the prior cycle peak. That underscores how we viewed the pandemic as a positive productivity shock, and that inflation pressures are not degrading profits. Increases are getting passed through, and we think that's likely to persist. It's all the more reason why the Fed should be normalizing policy. But this is the reflation stage of the cycle, which is good news for equities, not the inflation stage when multiples get crushed. So lots of data to look at this week. The JOLT survey this morning is a big one for us. Although it's June data, it does tell us a lot about this labor market dynamism that we think was very positively impacted by the pandemic, had the opposite effect of the global financial crisis, and will be good news for productivity and wages going forward. We will have some Fed speak this week, but not from the leadership. And of course, we get the inflation numbers that'll be crucial. So expect a much more meaty report from us this week, and it should be pretty interesting. Barry Knapp, Ironsides Macro. Thanks, everyone. Have a good week.